Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. Welcome back to another weekly Roundup edition of On the Margin. Today, I am joined, as always, by my almost IRL co-host, Mr. Mark Yusko, because we're going to be seeing each other this week in Austin, Texas, baby.
I know. Yeah. And of course, we're there Monday, Tuesday, Wednesday. So it's kind of like not really good for a weekly roundup. But I was thinking, we should actually
set up something live.
A live thing, record. But what I was thinking is we should do it at the venue and like grab people randomly and ask them economic questions and do some interaction. But that was my brainstorm. All right, quick reveal. I do have the Bitcoin pants on, even though it's hot down here in North Carolina. And I have the Bitcoin wizard join us with the Reddit because my friends at Mount Sox anchored me by posting that this morning. No, by tweeting it this morning. I'm not going to call it posting. They tweeted it this morning. I refused to call it posting. And anyway,
I think Twitter's never good. I understand the branding standpoint of X, and if you're expanding into payments, all that stuff. But they had a verb. You know how many companies get a verb? It's none. It's
very many. Look, yeah. X is dumb. It's just dumb. It's fail. He bought it 22 years ago or something. He did focus groups. Total failure. Like 65+% said, ugh, I would never trust a company called X. Terrible. Porn company, X-rated. No, never. So what does he do? He brings it back. And so
it actually never left, Mark. Because if you look, so SpaceX, the Tesla Model X, I think he named one of his kids X or something like that.
I know. But here, literally, first thing my wife says when the rebrand gets announced, why would you do that? It just sounds like a porn company. I mean, that is the reaction that you get. And I don't know, whatever. I say, how many companies get to become a verb? You Google it, you tweet. I mean, that is
not really a verb, but yeah, I'm with you. So let's talk a little bit about, we were just discussing before a little bit of a scant week for stories here. And I thought maybe instead of focusing on news items, we could have a little bit of a debate. Mutual friend of ours and friend of the show, Jim Bianco, I saw talking about bankruptcies in August. And I wanted to talk to you about it because I've seen some discussion of it on Twitter. And there are a couple of different ways that you could interpret this. So I'm just going to share my screen here so we can walk through Jim's entire thread. But the idea here is there's a recent spike in bankruptcies in August, which has been much talked about. Now, the reason why people pay attention to bankruptcies is because for many months now, folks have been waiting for a credit event, right? So this is something that typically happens anywhere between 12 to 24 months after a monetary tightening. There's a ripple effects that happens out in the economy. My understanding of it, it starts with interest rates that goes into housing. Housing and the economy are very tightly linked. So that translates to corporate profit margins and earnings, and then that translates into unemployment. So we haven't seen some of those steps take place yet. But when bankruptcies start to rise, people start to worry that there's some sort of big credit event out there. So what Jim has pointed to is that what we're looking at here is a graph or a chart of total bankruptcy filings. So there's the 3-month average, and then there's the monthly plot of bankruptcies. So in July, there were 10 bankruptcies. Then that number jumped to 23 in August. So this is related to the Senior Loan Officer Survey, which is the SLOOS, saying that they're tightening lending standards for commercial and industrial loans. The thing is that lending leads bankruptcies, right? So Jim's point here that he's making, if I'm interpreting it correctly, is that we've already sort of seen the change in availability to credit, which has led to this rise of bankruptcies. So I think what he's implying here, and I might get a message here that I'm wrong, but that's what we're already seeing is kind of the result of the tightening. But Mark, what do you take away from, I mean, when you hear this sort of rise of bankruptcies, are you like, look, this is still a relatively small amount and we're making we're making something out of nothing here in just the doldrums at the end of August, or like maybe
It's
this is signaling.
It's not a small amount. No, I tweeted this out there, or tweeted this out the other day. Said, is bankruptcy a synonym for strength? Asking for a friend, right? I mean, bankruptcies are bad. There's no way to spin them positively. There's no way to say, oh, it's not really a big deal. Look, every single one of us knows someone whose kid or friend has been laid off, right? There's 650,000 tech workers who've been laid off. There are now hundreds of companies that are folding. Look, bankruptcy is not something you do lightly. It's like forever. I mean, there are reorganizations, but true bankruptcy, Chapter 11 bankruptcies, liquidations, they are not, you don't come back. And so this idea that somehow it's a good thing. Now, I will argue, Mark, you say all the time that you have to cleanse, right? You have to let the good companies die. I actually do agree with that. I mean, I'll stand by that. That one of the challenges of the ZIRP world, the zero interest rate policy world, was we didn't let companies die, right? We just extended and pretended. You owe me money, but you can't pay. It's low interest. Just extend. And in a high interest rate world, can't do that anymore because now they can't even pay the interest. There's some crazy stat. I'm going to get this approximately right, but it's like a third to maybe 40%. I think it's like 38% of the S&P 1500, which is, the 1,500 biggest companies, not just the 500, can't service their debt. Not only could they never pay the debt back, which that's an endemic problem. We've got governments all around the world, people, individuals can't ever pay their debt back, but they could service the debt by and large. You pay the interest. 38% of the companies can't even service the debt. They can't even pay the interest. And now with the interest rates rising, that's why you're seeing the rise in bankruptcy. So I do think bankruptcy is a good deal. Is a big deal. And I don't think there's any way to positively spin it, which I think some people are trying to do.
Yeah. So the last part, and just to end this point that Jim was making, he actually did highlight one divergence, which is pretty interesting, which is what we're looking at here is a chart of bankruptcy filings and high yield spreads. So high yield spreads, this is sort of a proxy for stress in terms of financial conditions, and they tend to be extremely correlated. Bankruptcies and the 3-month average of bankruptcies and corporate yields or high yield corporate yields.
Spreads.
And right. And they've diverged in a pretty big way, which is just maybe something that's interesting to note. I think just to maybe put some context around this, Mark. So there's no way that this can be construed as a good thing. I think the reason why people are interested in this is because there are broadly two camps right now, which is this no landing, soft landing camp where, maybe this isn't going to be as bad as we all thought. And maybe the Fed landed the plane, versus there are some folks who say, hey, in 2007, we were debating whether or not we were in a recession. And then, 9 months later, we got Lehman. And that's, I think a lot of folks are waiting for, and that maybe we could just broadly categorize that as the higher for longer camp, which is that rates are going to be higher for a longer period of time. Anyone who's got assets that they can't finance are going to have to force sell them. There's a credit event that almost always happens after the Fed has been hiking as aggressively as it has, especially, and David Rosenberg has done a really good job of pointing this out, aggressively hiking into an inverted yield curve, which I think going back for the last at least 100 years in the US, it'd be very difficult to find instances of a Fed that has done that. So, I mean, what do you think about, is there some sort of impending Lehman out? I know it's a tough question to answer, right?
No,
But is there...
Look, we had a Lehman event, right? I mean, Silicon Valley Bank was the largest bankruptcy, I think, this century, right? In terms of banks. So now it wasn't an investment bank, and people don't think of it as important because it wasn't at the root of the slicing and dicing that was going on in the subprime market. But when your major banks, which are the bedrock of any, well-functioning society, crumble, that's bad. That is a credit event. And there are a whole bunch of other things happening below the surface that don't get the same amount of press. Plenty of community banks struggling, not just with their mortgage, not just with their treasury holdings, but now with their commercial real estate holdings. I can't remember who it was. Somebody just said they're going to renegotiate all of their leases.
Yeah.
It's like, we can't pay, and so we have to renegotiate. And our boy Elon said, I'm just not going to pay. I'm just not going to pay my rent, which I don't know if that actually happened or if that was just, to get publicity, because that's what he does. He takes whatever's hot that morning and he tweets about it. So, but I do think that, look, there are thousands, probably hundreds of thousands of commercial properties that are totally upside down. Cannot be refinanced, right? Impossible. Can't make the cash flows foot at current interest rates. And the only hope they have is that the banks extend and don't foreclose. Kind of like what if you had a good friend in banking during global financial crisis, you could make that happen. So Bill Ackman and a few others had that happen, but most of us don't have friends in high places. So people have to pay their bills. And I do think it's an interesting phenomenon that the people at the bottom, socioeconomically, and I don't mean that derogatorily. There's the top and there's the bottom. It's just math.
Yeah.
Have to pay their bills, right? You're expected to pay your bills, pay on time. If you don't, you get evicted, you get repossessed. There's bad consequences. If you're at the top and you don't pay your bills, let's figure out how to restructure. That's how to refinance. Could we do some funky tax dodging? And people help you when you're a big source of revenue for them. And when you're not, you're crushed. And that's why you say, did the Fed land the plane? Yeah, they did. But there's this great cartoon, and it's the jumbo jet 747 with the super first class at the top, and then the middle section, and then there's the cargo. And basically, the Fed landed the plane, and you got the 1% up in first class, and you got the average middle class in the middle. But you got people holding on to the landing gear. They just got squished. And one of the things I wanted to do today, I wanted to hijack or heist the conversation, and I want to ask you, what's the best question you were asked this week? Because I feel like questions are more important than answers, and most of the time a podcast is all about answers, right? You ask questions and people answer, and that's what podcasts do. And I always think that the questions are really the most important thing. And you have this nice vantage point in that you do a multiple of these every week. You talk to a bunch of different people in different areas. And so, not to put you on the spot, but put you on the spot, what was the best question that one of those people asked you?
Yeah, you made me think about that. I actually got invited onto Bankless podcast and went on there and gave a little chat about.
I have it in my inbox to listen to this weekend.
Nice. Well, there was
a good glamour shot, by the way.
That's a very old photo. I gotta make that not the default photo. Hey everyone, we'll get back to the show in a minute, but just wanted to let you know that we've got our permissionless conference coming up. This is the one that we do with Bankless. It is the biggest and best conference in DeFi. It's going to be in Austin, Texas this year, September 11th through the 13th. Now, you've heard me say this many times on our show before, but the time to be bearish on crypto was 18 months ago when the Fed began raising rates. Since then, our entire market is down more than 50%. We've had all this bad news. In the last 2 weeks, we had BlackRock and a whole slew of other institutional investors file for a Bitcoin ETF. This space is not going anywhere. So if you're interested in investing in this space at all, I highly recommend that you attend this conference. The other thing, and I've said this before as well, bear market conferences are the best ones. In the bull market, you have all this retail, all this noise. Now you only have the people that are really here building great products. This one is worth your time 100%. And since you are such good listeners to On the Margin, which I really appreciate, giving you all a special 30% discount code. It is MARGIN30. Now you can access that by clicking the link in the bottom of the show notes. So you can see my fingers pointing down, click that link. Because you are a listener of On the Margin, you get 30% off to the conference. Again, the code is MARGIN30. We'll see y'all there. Ryan posed this question just about, it's very tribal now we're moving into the world of crypto a little bit. But for those who don't live in it day by day, if you weren't in crypto, you might just assume that it's one big homogenous group of weirdos, right? And it's not. It's a very heterogeneous group of weirdos. And really, there is the Bitcoin culture, which many people would be really familiar with. And that's the very macro money sort of culture. Just going chronologically, the next big ecosystem to arise was Ethereum. And that was, in a sense, it's a very different architecture. They're sort of trying to be a money. I don't really view it 100% that way.
The Bankless guys do, but that's their problem.
Yeah. Very, very different culture. It's almost a reaction to Bitcoin, which is a little, Bitcoin, to be the least charitable description, is a little doomer sometimes. A little, I think the best way to characterize
they're the survivalists. They're the anarchists. They're the.
I think what they want,
libertarians.
I think the Bitcoiners, much like the gold community, want there to be consequences for the actions, especially of what central banks have been doing for the last 100 years. And right now, so I think a lot of finance is a little bit frustrating today because it seems like the one answer for everything is the Fed can buy all the assets and squirrel it away in this box. And the gold and the Bitcoin people, I think, are correctly like, hey, this doesn't make sense. But the Ethereum people have
the extreme of that is they're like, burn it down.
Yeah. I don't like that.
Burn it down? No, I like normalcy. I don't want anarchy.
I don't want to be in the place when it's burning down.
I do not want Mad Max. Do not bring back Mad Max. That's not what we want.
So anyway, this whole podcast was on different ecosystems, and it made me think about my philosophy for how I see tribalism playing out. And I'll bring this back to actually something that we talk about on this podcast a lot, which is everyone getting sucked into this great power competition between China and the US. And every time we talk about China on this podcast, some people, you American have no idea. I don't, but this is my perspective on it. In crypto, I am glad that there are multiple different ecosystems. In the same way that I am glad, despite having a bias living in the United States, I love the United States. I know everyone hates when Americans say this. This is just my opinion. Please do not at me in the comments. I think it's the best country in the world. But I'm really glad that it's not the only country in the world. And I think if America was the only country in the world, then it would stop being the America that we love and cherish, right? So the reason I'm saying that in this great power competition thing is I think a lot of people tend to be very binary and say these criteria or attributes of America or whatever country you're from make it the best in the world. Whereas what I would say is, I think that's totally fine opinion, but I think it's also fine to have, and actually a very good thing to have, many different countries and perspectives and ways of viewing the world. Same thing applies to crypto, I think. And I think if there was just one dominant, homogenous point of view, then no one challenges that point of view. Competition is good, and that's what keeps you honest. Honestly.
Yeah. All right. But I'm not going to let you wriggle off. So, what was the best question in that interview?
Well, the question was, what is your philosophy on these crypto ecosystems? Yeah. Okay. And that's what I tried to describe. I think a heterogeneous mix of different cultures and ecosystems and opinions colliding with one another is much better than what I think a lot of people would say is my culture is the best and I want everything to be like my culture. And what I would respond to those people is, if your culture became the dominant only culture that existed, it would probably lose a lot of the attributes that you actually really like about your culture.
You're triggering something that I kind of remember this from my history. Nazis.
Yeah. Well,
that was kind of the whole point. Our culture is right. We're going to foist that on everyone in the world. that would have been a bad outcome. So, the idea that
I'll give you a less extreme example.
Homogeneous outcomes are superior. It's like bloodlines, right? If everybody comes from the same bloodline, bad things happen biologically and genetically. It's not really good.
Yeah. So just to maybe even dive a little bit more into that nuance of, right, let's rewind the clock back to World War II. We know who was on the Allied side and who was on the Axis side. It's very easy to say Nazis bad, et cetera. Now let's take us back into the present time. Japan, which, did horrible things during World War II, now are looked at as a very progressive Western sort of economy. Who would have seen that coming? And then, by the way, at the time, Russia, the Soviet Union, and China, which were on our side, look at how they've shifted more towards autocracy. And by the way, Hitler demonized as one of the worst humans to ever live, probably because of the systematic way that they exterminated Jewish people.
Exterminating people.
But
that'll get you a bad rep. It's amazing that will get you a bad
it's
rep.
horrible. I'm not defending it all. But the leaders of China and the Soviet Union at the time, you had Joseph Stalin, who arguably is responsible for more deaths than Hitler. By the way, and it took a long time after the death of Stalin for him to be, what's the word? For the perception on Stalin to shift. And the same thing with Mao Zedong.
I mean, no, but the difference is subtle difference. If you want to make your country a certain way, and the you is the people at the top, right? Because that's always the way it happens. It's a small group of people that are controlling this. If you want to make it a certain way, okay, maybe it's good, maybe it's bad, but it's the problem is when you turn that out and you're trying to make everyone else like you.
Yeah,
that's to me what the difference between a Nazism and American exceptionalism. We influence other countries, okay, and don't pretend that we don't. I mean, we certainly influence other countries, but we don't, at least not lately, we don't try to take them over. I mean, there was a little annexation, not of countries, but there was a little bit way back when. And China, same thing. China's not out gobbling up other nations. They may influence, through trade and relationships, but they're not. It's just that to me is different. All right, so your question was on philosophy. My question this week is, how is the consumer so resilient? Right, back on the road a little bit, and the airport's still full, and the one that really got me, and it's a silly one, but it's Friday, and I got my Irish belt on, and the Irish are coming down here to North Carolina to play at NC State tomorrow, and I started thinking about this. How? Because I went up to the Tennessee State game at Notre Dame last week, and I expected it to be 3/4 full. Because basically Tennessee State, no offense to Tennessee State, but it's a band that happened to bring some guys along to play football. I mean, everyone came to watch their band, their band is amazing. The band is just amazing. It's like that movie Drumline. I mean, it's an amazing band. But the football team, they have a great coach, Eddie George. I mean, he's amazing. He's amazing. Just amazing guy. And he even said, yes, we definitely have a, chance to win this game. No, and that's why I said it wasn't much of a football game. It was a great experience. It's a nice day. But thousands, 80,000 people spent thousands, plural, of dollars, right, per person. When you take travel and lodging and food and tickets, which have gotten crazy expensive. Now, I think it's interesting. These are the same people that complain that Hamilton tickets are too expensive and I'm not going to go. I guarantee you going to Hamilton would make a bigger impact on your life than watching that football game. Guaranteed. Any football game. Doesn't matter which football game. Any football game. Hamilton would be better in terms of what's your memories. And okay, you're in the national championship and it's your team. Fine, that's a good memory too. But a regular football game like Lincoln, Nebraska, right, which becomes the largest city in the state every Saturday. Go to Hamilton once. I mean, anyway, so it's a long-winded way of saying I'm struggling. Like, and I don't want to put you on the spot about Blockworks, so I won't, but most companies I know have fewer people today than they did a year ago. Vast majority. Okay. And I know we do. And some of that's good attrition, like people who decided they were going to go do great things and get promotions, and we're like, they're not going to tell you not to do that. That's a great thing. And we didn't do any systematic layoffs, but our hiring has been infinitesimally small relative to our history. I also know I did not hand out 7% cost of living increases in the last 2 years. Just didn't do it, right? That's not something we do. So if the number of workers is down and the number of the wage gains relative to inflation haven't kept pace, how are people still spending? And I don't know if you've been to lunch lately, but it seems to cost a hell of a lot more than it did 2 years ago. I don't know. So that's the question that's haunting me right now is how is this resilience happening?
So maybe there's a more complicated explanation, and then there's an Occam's razor explanation, which is just the simplest answer, maybe is the correct one. Or maybe it's just as simple as housing has absolutely ripped in the last 2 years. Housing hasn't gone down, and everyone just still feels that wealth. So that's maybe if I really had to put it to one thing, because my mental framework, Eric Bismasian gave me this framework, is this change in the velocity of interest rates, right? There's some sort of monetary change in regime. Then the super interest rate sensitive sector is housing. Housing is people's wealth. That fuels consumer spending, which is where earnings start to miss and corporate profits start to compress. And then you get to unemployment. We just never had that second stage, which housing has stayed extremely resilient. And it's not, housing. So I saw the statistics, right? I saw the inflation statistics on housing. Look, all I know is my parents made a move to Montana, not to put them on the spot, but they didn't even move super early in the pandemic. They moved like halfway through the pandemic. 1 year after they bought their house, it almost doubled in value. Doubled. So, I think it's this, and these credit cards.
Okay, but let's pull that thread. But then did they take out a home equity line of credit to put cash in their pocket so they could spend more? Or did they draw down savings because now they had this nest egg in the form of equity? Because I get it that your wealth goes up if your house appreciates, right? I've said this in the past 2 years, in theory, according to Zillow, my house went up 40%. Like, it didn't grow, it didn't get more efficient, so the money got worse. And that's fine, but my point is that increase in wealth doesn't change spending unless people take out a home equity line of credit and pull the money out and spend it, or draw down other forms of savings or retirement assets and spend it, or incur a bunch of debt on credit cards, which I know that's true, right? We had credit card debt hit $1 trillion for the first time. The other thing that I saw that was interesting, we had car loan debt hit $1 trillion for the first time. Trillion here, trillion there, pretty soon you're talking real money. So that's interesting.
So one other, I don't know. I don't think my parents, I have no idea how they financed the home. But the other thing that you could have done, there was during the pandemic, especially when stocks were ripping, your broker, whoever was selling you the home, say, hey, you know what? Instead of selling stocks to buy this home, take a loan out. and by the way, do it at 1%.
Margin debt is definitely part of it, right?
Yeah.
Absolutely no question. And margin debt has regimes up. So, but again, if it's debt, then debt
I hear you,
eventually has to get repaid. And as interest rates tick up, those margin loans, they're not free anymore.
So I think there are many people in the US who live paycheck to paycheck. There are many other people who don't live as paycheck to paycheck. And I think people are less economically rational than you might give them credit for. People aren't structuring their personal balance sheets like you would a business, right? They're not looking at assets and liabilities and these my cash, like kind of. But I think most people sort of group everything together mentally. And they're like, here are my stocks, here's my house, this is how much money I have, this is how much I spent. They might in their head weight a little bit towards, well, this isn't super liquid, but I don't think they really think about liquidity and what would happen in a worst case sort of downturn.
Oh, no, 100%. Look,
the
average person can't raise $500 for an emergency. It's very sad, but very true.
Yeah.
The average 401k balance is in the 50,000s. 50,000. Yeah. Think about it. If you retire at 65, life expectancy now is 78. So you got to last 13 years on 55K. Not happening. So one, you just don't retire at 65 if that's what you got in your retirement account. Or, you move in with your kids or, I don't know. I mean, there's probably a business here to create old-fashioned communes, right? Like, shared living where you could, have dorms and probably actually be good socially. But
yeah, I'm struggling to, and this is where, so that was, I was being a little bit reductive there with just the Occam's razor housing. I think it's at an even higher level, what the Fed has been incentivizing. The Fed puts their thumb on the scale, right? The Fed says, I have an opinion on where the economy is at. Here are these indicators that I look at, and I try to smooth out the business cycle. There's actually a great quote from Janet Yellen, I forget, somewhere around 2017, saying that's probably the last financial crisis that we will ever see in our lifetimes, which is, why would you say that and jinx yourself like that and get yourself on the record? But it doesn't matter. But what is the Fed?
Actually, I'll tell you why she said that, but we'll come back to that. I'll tell you exactly why she said that.
Okay, so what has the Fed been telling everyone to do for the last 3 years, really? They've been telling you to spend and invest like a drunken sailor. Mm-hmm. That's what they've been telling you to do. And you've just gone through this psychological, there's like, we still haven't totally left that psychology, right? The Fed has been, the Fed at one point was extremely worried about deflation when COVID happened. Oh my gosh, the economy is shutting down. I'm going to worry about this later. And I would argue there's a lot of merit to this way of thinking. Worry about it later. We got to pump demand into the economy. I want people spending money and I don't want enormous amounts of homelessness. And what they were psychologically telling everyone is that don't worry, it's going to be fine. Just go out and spend, go out and invest, do all this stuff. That's what they've been telling us. And people just haven't gotten out of that mindset yet. And then the other thing is, look, housing is one thing. Where's the pain? Show me the pain in the stock market. It isn't there. Look at the indices they are flirting with all-time highs again. So the economy is really financialized. All the financial assets are doing fine. Employment is still record lows. Maybe that's it. I mean, where's the pain? Where's the pain? I think that's
the pain's in the cost, right? Stocks, quote unquote, are flirting with all-time highs. No, they're not. You're pricing them in dollars. Price them in gold. Price them in Bitcoin. They're down a lot, right? And stocks say the same price they were in 1997, priced in gold.
I know, but most people wouldn't
same
think
price.
Like that, right?
No, I understand that psychologically we think today's prices are normal, but parking, right? I took a day trip to New York yesterday. Parking for the day is double what it was 10 years ago. Now, you say, but that's normal. That's what's supposed to happen. It's not. The parking is the same function. It's the exact same function. My car sat in this covered garage for the same amount of time, but I paid twice as much money. I didn't get any more benefit. The money got worse. And where was I? I was in Oh, I was in Chicago for the football game, and parking there, $30 a day at Midway, right? Not $20 a day like it is here, $30 a day. Now, if you went to O'Hare, it's like $72 a day. Think about that for 1 second. $72 to park your car for 24 hours. That's more than almost 3 days of minimum wage after tax. That's a crazy number. Yeah. So I get it that humans don't think in gold terms, they think in dollar terms. And, NVIDIA is $400 or whatever, $470. They don't think, selling at 40 times revenues, really 40 times, 40 times revenue. And look, I'm wrong, right? I said it wouldn't go above 429 and it got up over $500. And I have this friend, Rob, who was a former hedge fund guy. Now he just manages his own money. And he's one of the smartest tech investors I know. And he's old like me, so he's been through the cycles. Like there was some, and I shouldn't pick on him, he's a young guy who was saying, this is worse than Cisco. Well, you weren't there during the Cisco period, and it's okay. That's not a criticism, but you actually didn't do the work. And Rob said, I challenge you to a podcast, head on head. And Rob eviscerated him very nicely, right? I mean, he sliced him and diced him, but he did it in a very nice way because Rob's a very nice guy. And I came away saying, okay, it's possible that NVIDIA could do better than I thought in terms of sales, because people are actually migrating from CPUs to GPUs, even though theoretically there's some functions that doesn't work for, but okay. But the multiple's still wrong. He's like, yeah, I know, right. but it's a different world. And that's your point. It's the financialization issue. And look, there's a reason that every piece of legislation, right? Like tax relief, right? Why did we give big corporations tax relief? Why didn't we give individuals tax relief? Well, guess why? Because we need those stocks to go up. Because if those 7 stocks don't go up, the average American puts their hand out to the government and says, you got to bail me out.
Yeah.
Because they don't have any money to retire. And they were promised, this is the thing, they were promised in 1986 that this change from a defined benefit plan where your company took care of you in old age, right? It was a defined benefit. You got taken care of and they took the investment risk. And if they didn't have enough, they had to put more in, to defined contribution where they put a certain amount in and everybody says, oh, it's so great. It's free money. They matched how much I put in. Well, you're putting money in. You didn't used to put money in. They put money in for you. Oh, but it's portable. I can take it with me when I change jobs. And how often do you manage it? When was the last time you rebalanced? When was the last time you looked at your asset allocation? Could you even invest in the best assets like venture capital and real estate? No. So that's this ruse that's been going on. And it's frustrating because an entitlement, and we've talked about this and that, is a promise you make to yourself that you don't fund and you ask your kids to pay for. The boomers are awesome at entitlements. We passed a ton of them. And we would like to have them. And we'd like you to pay for them. Like also, I would really like you to pay for my entitlements. And I've told this story on my mom, and I love my mom. And but she really believes there's a pot of money in DC called Judy's money for her Social Security. No, Mom, you get money from me. That's how it works. It's yes, you did put some money in, but it wasn't nearly enough. And so me and 2.5 other people right now, it's like 3.5, give you a portion of what we put in and they pay it out to you. The problem is when I reach retirement age, there'll only be 2 people working for everyone retired. And I make the joke, I had 2 kids, so I lose. They give the money to my wife. Okay, so I'm done. So I had to have another kid, which we did, but I only had 1 other kid. So I still need you or someone else to help bail me out. So that entitlement problem isn't going away. And so everything, think about taxation. Why do we get to deduct mortgage interest?
By the way, just one point there on the little pyramid that you described of paying entitlements. The thing that I take away, and I always come back to about this, and this features into because we're having a big ideas episode and just sort of riffing here. The idea that this always comes back to for me is these 2 philosophical camps that I sort of see loosely formed, which is one, which is a pro-growth camp, which is humanity needs to grow, and there are certain growth expectations baked into society. And then there's this other camp that says maybe we have enough and we should enjoy our, the things that exist. And I firmly would be in the camp that humanity is a species that needs to grow at every single level, at the individual, at the community level, at the corporate level, at the national level, at the species level. And honestly, just as maybe there are people out there, hopefully people listening to this have multiple job experiences. When you start to think, what was a good job experience versus a not good job experience? I bet, ask yourself, is it better to be at a company that's growing or not growing? And honestly, ignore every other factor. Ignore every other factor. Ignore your boss. Ignore where you had to work. Ignore your hours. Is it more fun to work at a company that is growing or not? And if you are working at a company which is stagnant for multiple, just not as fun.
Brutal. No, it's and brutal. Look, fun is good. Fun is good. Interest is good. Drive is good, and motivation is good. All that's great. But look, you're 100% right.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Bringing it back to finance a little bit, the growth expectation that was baked into the economy, right, is 7%. That's the target for pensions, and that's sort of the promise, and that's why there's this need to grow. It was a sort of social that 7% number was a target, and it became a social contract. And now, if pensions are underfunded, then that's an enormous problem, and that's where we sort of find ourselves, I think. And maybe let me just ask you a question, because
questions being better than answers.
Yeah. So Jim is going to get a second feature on this podcast here because I actually saw Jim and Mike Green, who's another friend of the pod, who's come on and talked to us before, going back and forth. But the Cleveland Fed updated their inflation nowcast on September 5th, so 3 days ago. August CPI is now projected at 0.79%, which would push the year over year to 3.82%. September CPI is now projected at 0.45%, pushing the year over year to 3.91%. Driving this has been the rise in gasoline prices. So the caveat here, and what Mike pointed out to Jim, is that the Cleveland Fed has a very, first of all, they've been overstating in recent months, right? So if that trend continues, it's safe to assume that these projections are coming in a little bit hot. And there's a very sort of simple methodology that they use to calculate the nowcast, which might not be reflective of all of the different components that's actually happening out there in the economy. That said, they haven't overstated by that much. So they've consistently been overstating inflation, but it's been by 30 bips or something like that. So even if we got the question that I'm trying to get at here is, regardless of the Fed Nowcast and how accurate that is coming out of Cleveland, I think, we've been talking, is there going to be some credit event? Is there another shoe that's going to drop? Is there a recession? Probably, I have no idea. But if we have conquered the inflation beast, then there's a better chance than not that we will have avoided the worst of it. Yeah. What would really be a turd in the punch bowl is if inflation started to kick back up. And that feels like a lot of people have discounted that out and counted that out as a possibility. But if you look at the two major historical inflationary periods in the US in recent history, the 40s and the 70s, it's a consistent pattern in both, right? If there's an extreme spike in inflation, looks like we've defeated it. Spikes right back up, looks like we've defeated it. And Volcker famously had to cause two recessions. Finally, in the late 70s and 80s.
You know how I feel about it. The 70s, and Mike Green's actually the guy who talked about this. The 70s is just bogus data. It's just bad data, right? The Volcker Fed was double counting the number because they counted housing and interest rates in the inflation data. It was never real. And so him jacking up interest rates to 21% was because he had bad data. And it was a self-perpetuating thing. Every time he jacked up rates, they told him that inflation was higher. And it's like, because you're wrong. It's just like and there were no spreadsheets back then, remember? So it was just, the 70s don't count. They just don't count in terms of data. It's kind of like 2000 when people say, oh, the average return on stocks is X. Like, no, we have polluted data. You're looking at the last 30 years. Oh, my favorite is the trend of the forward earnings is 15. Like, are you joking? You're looking at the last 30 years, which are polluted by a period of idiocy, right? Which was the Cisco Sun microsystem. Look at the whole history. The number's 11. It ain't 15. So to make yourself feel good that the 18 we're selling at now is somehow low, you're smoking crack. But on this point of inflation, the 40s, and Lynn Alden has done a great job, analogizing this. The 40s is a great analogy because we had the crash, we had the recession, the Great Recession, that then started to recover, and the Fed ended QE, and in 37, we had this relapse, and so the 40s were the recovery from that. You also had demographic difference or demographic age that was similar to now. And so there are a lot of similarities with the 40s in terms of fiscal policy, monetary policy, demographics. So that one I buy. The 70s to me is silly. 70s was good old fashioned. Supply got disrupted because of Iran-Contra and oil. And we had the bad data in the housing for Volcker. And so, he broke the back of inflation. No, he just broke a bad model. So, and Iran didn't blow up into what it could have blown up into. So now inflation, to me, the Nowcast is the same as the non-farm payroll. Every single month this year, 100% of the months this year have been revised down, many materially. Yeah. So 335,000 jobs that were reported as created were never created. So it's not bad enough that the actual stuff that's revised is wrong because of the birth-death ratio. They overstated it, I believe, intentionally, 100% intentionally, to craft a narrative that labor is strong so we don't have to declare a recession. And look, saying there was no recession in 2022, it's just stupid, right? The year-over-year growth in GDP was 0.9.
So hard to get an opinion out of you, Mark.
Definition.
I'm just begging you to have an opinion.
What?
I said it's so hard to get an opinion out of you. I'm just begging you to just come down one way or the other.
You know, that is why this is the best hour of my week. Because where else can you just rant and actually say what you believe and not have everybody go, oh, I don't want to hear that. Oh, that offends me. That's tough shit. Don't listen. That's my favorite. When people put in the comments, you can't say, don't listen. Don't follow me on Twitter. It's my prerogative. That's why it's the greatest country in the world, because I can say what I think. And you don't have to agree with me. But if you don't agree with me, how about we have a dialogue? And how about we have some debate? And how about we try to seek truth? And how about I try to learn from you and you try to learn from me? But this whole, oh, you're dead to me. You said something I disagree with. You're dead to me. Shut up. Anyway, so, but yeah, I don't feel strongly about this one. But no, I feel really strongly about this one because I think the data that we all think of that's accurate, I think it's crafted. I think the government does nothing unintentionally, right? Everyone says, oh, they're idiots. No, I mean, collectively, maybe, but individually, they're some smart people. And I believe that it's all crafted. And it's crafted to do one thing and one thing only: maximize the wealth of the people in the all-seeing eye, right? I love that when I do it. That's what it's crafted to do. So, and whoever sits in the chair does the same damn thing. Left, right, up, down, blue, red, green, purple, they all do the same thing. If you can use power to enrich yourself, I hate to say it, but you will.
A lot of people do. I have one more question for you just about on the inflation thing. We had Vincent Deluard came on the show, can't remember, a number of months ago now. And he said something which I've thought a lot about. So the Fed loves to talk about R star, right? Which is this reference to what interest rates need to be in order for there to be equilibrium in the economy. Okay. It's a very hypothetical metric and number. There's another number as well that is much less talked about, but it's the I star, which is the natural rate of inflation. And one thing that we're talking about a little bit.
Just let that linger there for a second. The natural rate of inflation, the natural rate of currency devaluation, the natural rate of theft from the masses to the few. There is no natural rate. That would be zero. There is no reason the currencies should be devalued. None. Zero. But they have this I star.
They have an I star. Well, what about when there's a mismatch in supply and demand generally? Like to use an extreme example, right? During COVID, they took all of the supply in the economy offline. It's an enormous part of the supply.
That's what inflation is. I don't have to print money to make that. That's what inflation is. That's why I say we don't have inflation right now. We have currency devaluation. That's totally different. When supply and demand work and the lines move, price adjusts. That is an equilibrium. This other stuff, calling inflation an equilibrium, that's just bogus bullshit. No.
So
not your bullshit, but their bullshit.
No. So let me ask you this then. If the inflation that we're seeing right now is currency devaluation, isn't the amount of debt the most causal factor for our inflation? Because eventually, right? That's what it has to be. Like if that's the fundamental thing that's driving it, because we have too much debt to ever repay the traditional way, so you have to soft default.
4 choices. You can pay it back. Can't do it. You could tax the wealth of the nation. Can't pay back the debt. So you're not going to pay it back. You can restructure it. The Chinese and Japanese are already selling the unrestructured debt. They're not going to buy restructured debt. That ain't going to happen. You can default. When you default, you get kicked out of office. Not going to do that. You can devalue. Every empire in the history of the world has crumbled for the same reason. Excess spending, funded by debt, fuels the need to devalue the currency. You devalue the currency. The rich get rich for a period of time. The poor get really, really poor. And eventually, the society crumbles. And it ain't different this time. It's just happening in slow motion. And it's literally the boiling the frog, right? If you drop the frog in hot water, it jumps out. If you put him in cold water and turn up the heat, he's paralyzed. She can't jump out.
So I agree with you that it's very typically a facet, but it's not the only thing. But a lot of the other things that you see are also appearing. Classic.
Okay.
I see a lot of the
lines. Student of history, so yes, there are other
things. A lot of what it is overexpansion and investment in. This is a very difficult. Look, now we're just frankly wading into politics, and I don't know. But military spending is always a feature of it as well. So Rome, like part of the decline of Rome, and it's very hard to find any two scholars that agree. So they list all these different reasons, but a lot of what it was is when Rome was originally set up, it didn't have the administrative chops to manage a whole bunch of different lands. And eventually,
they were thousands of miles apart where it took months to get there.
Right. So there's just the administrative burden that was eventually placed on Rome. It was enormous. They also had to feed everyone in this empire as well. And that essentially liability and that immense amount of overhead that they had to figure out, that was a big part of, as well as just frankly, a very dysfunctional set of emperors and never having fully learned this. They eventually started to splinter, and that's when the devaluation of the currency came in. More administration was brought in to save these cracks, and it all just sort of imploded and crumbled under the weight of itself.
The subtle difference is in those times, because of the absence of mechanized power, hadn't discovered oil yet, didn't have great agricultural technology. When things got tough, you actually, I won't say justifiably, but you needed to use your military might to acquire more land, more goods, more people to do, because there were some slavery issues. But we don't have that today. The wars that we do now are to enrich people. I mean, Mitch McConnell, when he actually finishes a sentence, and I shouldn't poke fun at the guy because I really do feel badly for him and his family. I mean, I think he's really declining. But he said live, don't worry about that money that we're sending to Ukraine because it's not staying in Ukraine. It's coming back to businesses in your community because I chose them and I own a piece of them. And I mean, he didn't say that part, but that's true. And
that would be a pretty bold thing to say on TV.
Well, no, but it's true. I mean, it's 100% true, right? I've told you the story that, remember when we made everybody stockpile Cipro during the anthrax scare, and it turned out Donald Rumsfeld was the chairman of the company? Like, really? You made that decision to pick that drug that you own a piece of the company? Really? Or, Dick Cheney and Halliburton and restructure of Iran and Iraq? It's about the money. So the military-industrial complex exists today for a very different reason than it did in Roman times, I will argue.
Actually, Mark, it was the same in Roman times. There were extremely lucrative appointment of being a governor of a foreign colony and things like that. And what would generally happen is you, as an up and coming statesman, if you were from the right sort of family, you would ascend the hierarchy within Rome, and then you would go get a very lucrative position being the governor of Cisalpine Gaul, for instance. And then you would try to run military campaigns. You would extract an enormous amount of wealth. You would come back to Rome. And just as a cool, I think we might have talked about it on this show.
All right.
I read this. This was about a year ago. I reread this book. It's by the author of my new favorite podcast, The Rest is History, Tom Holland. He describes this system around, this was when Rome was still a republic. But what would happen is, the Rome did not have an enormous amount of administrative capabilities at the time, but they still wanted to extract tribute. So what they would do is they would farm out essentially contracts to go be a governor of this sort of municipality, extract taxes, and you could actually benefit. You would have to front the state. I'm going to have to go back and check that this is exactly how it works. You fronted the state the money for the taxes, and then you could go collect the tax yourself and take the difference.
And arbitrage.
Yeah. And by the way, this is what they did. This is just a cool little history lesson. They got the senators in on it. They made them shareholders in the company. And actually, they created, back at this time, the first form of limited liability. And do you know how they achieved limited liability? They made a slave the owner of the company. They made a slave. I mean, So this, what you're describing, I have no idea how it's played out, but this game has been going on
All
for
right,
an
I love
extremely
that.
long time.
I love that I'm wrong, and I love, but what's interesting is you just described the CCP, which is really amazing. No, the way they put the wealthy kids in charge of certain prefectures, and then they have to pay tribute, and they arbitrage, like I say, by collecting more from the. Like I said, when we invested in the 90s in China, the local municipal tax always seemed to equal our profits. It's just funny how that worked. And I said they never stole our money. We got our money back, but we never made any return. And that was a sucky period. And finally in 2005, the princelings, these princelings, they're actually called princelings, would allow us to invest side by side with them. And we actually made a lot of money. I mean, because they made more because they were leveraging their own money with our money, which is pretty cool. And they took fees. And so everyone was happy. And now, those funds got so big that the alpha went away because there's only so much graft and corruption that you can take advantage of. And now you actually got to work hard but there's now real innovation and company formation going on in China, which is interesting, contrary to popular belief. But we could talk all day, but I know we have to end the best hour of our week. Thank you for the updated history last time. I'm psyched to actually go listen.
I've got to go back and it's been a little while since I've read this exact, but I started. There's a great chapter
I know
on this.
You're right, and if I think about it, it makes perfect sense. I think my point is still a little subtly okay, which is that if you're running out of food and land, acquiring more to grow to feed, now they're the slaves that you exploit, but to feed them and house them, I'll say is a little bit different. Like in the United States, we don't need anything. Literally, we got land, we got resources. We don't need anything. We don't need to fight a war in Iraq. We just don't. Full stop. We don't need to fight a war in Ukraine. We just don't. Full stop. So there has to be a different reason. Whereas if we were running out of land and we wanted to take over Canada, I mean, that would be justifiable, right? I'm just kidding around.
It's very hard to see, even through the lens of history, it's very difficult to fully attribute reasons. It's probably even more difficult as it's actually going on because I listened to, again, I'll just give two more shills to this podcast, which clearly I've been consuming rapidly, but the most recent episode of The Rest is History is an episode of Deng Xiaoping and the transition post Mao, which is an extremely interesting episode. You go and listen to it. And I listened back, I think the OG best podcaster of all time, hands down, not even a competition, is this guy, Dan Carlin. So he is the host of a podcast called Hardcore History. And if you ever want, I mean, this guy he'll do, he will do these 5 hours, so 25 total hours of podcast on like the Eastern Front in World War II, Eastern or Western Front. I mean, it is, he's truly, he does a very good job of being very objective, but also delivering multiple sort of subjective points of view as well that compete with one another. So it's very engaging. You might have to pay for him now, but just phenomenal.
What's his name again?
Dan Carlin.
Dan Carlin. All right.
Yeah. He's so good. And he was on, I went back and found this old episode of him on The Rest is History, where they were debated. This was going on around the time of, I think, the Russia invasion of Ukraine. And again, I don't want to talk about this too much because it could get political, but he was talking about propaganda and psyops from different governments. And the point that he made, he was like, of course everyone is doing it. Of course every country is doing it. And I think actually you could make the argument that if you weren't doing it, you would be doing a disservice to your country because you're not pulling on an important lever that everyone is pulling on. And if you were to engage, if you were to enter an engagement and then that engagement were to not be fruitful and there's some sort of post-mortem and it's like, hey, did you do everything that was in your power? No, you didn't pull on this one lever that has been getting pulled since the beginning of time and everyone else was pulling. So why didn't you? It's just, look, all this stuff, I know we got to close here. All this to say, all of this is very complicated and it's tough to ever.
It is complicated and it's it's complicated by the fact that, for all of our foibles, humans are the most amazing thing, right?
We're clever. I'll give us that.
Way more interesting than computers and AI. And I mean, humans are pretty amazing and complex and challenging, because I always say it's the randomness, right? It's the randomness of, think of how many thoughts you have. I heard the number once, but it's just an incredible number. And we actually address a little teeny tiny fraction of those thoughts every day, but there's thoughts coming in. And the ones that you actually pick, or that someone reminds you of, or you see something, or my favorite is you smell something and you're transported back to that place. That's just such a wild thing. So there is this complexity. But what I love about, and actually the book Complexity is a great read. It's about complex adaptive systems and the Santa Fe Institute and all these heroes of this construct of chaos theory and complexity. But it's a tough read. It's not like a Ben Mesrick book where it's just like, you can't put it down. It's so good. And I want to see Dumb Money. Is it called Dumb Money? What's the new movie?
Dumb Money is the
I can't wait. I mean, one, he's just a great writer and the story's great and it's such a cool story, but the casting is so good. I mean, I know Stevie and Gabe. I mean, and I'm sure they're not happy about the casting, but it's so good.
Yeah. It's so the movie that Mark is referencing here, Dumb Money, is a story about Roaring Kitty and the GameStop fiasco. And yeah, the casting of this is, I'm just looking at it right now. So Paul Dano is Roaring Kitty. Shailene Woodley, Caroline Gill. I'm actually not 100% sure who that is in the story. Seth Rogen is Gabe Plotkin. Pete Davidson is Kevin Gill. Sebastian Stan is Vlad Tenev. Who is someone really funny? Nick Schwartzman, I think, is Ken Griffin. Ken Griffin's in there.
Yeah.
Man,
the casting. I mean, the casting. It's perfect. As I said, they're not going to be
Nick
happy.
Offerman. It's Nick Offerman. Sorry, I messed that up. The Parks and Rec.
They're just. I don't know.
Offerman.
Steve Cohen is one of the most successful traders in all of history. Right. Just full stop. Now, discretions aside and all that, but he looks a certain way. I look a certain way. We all look a certain way, and they nailed it. They nailed it in the movie. And
who is Cohen in the movie? Is he?
I don't know the actor. I
can get it here. All right. So
anyway, but
it's Vincent D'Onofrio. I'm not sure.
D'Onofrio. Yep.
Last thing about this is, Mark, the storyline. I was very curious how they were going to cover this, right? There's a lot of different angles that you could have taken on how this whole saga played out. And by judging on the trailer, there might be a lot more nuance in the movie. It is, the way that it looks is a little bit of a Robin Hood sort of saga where there are these big hedge fund guys who aren't as smart as they look. And there is a guy who saw a crack and a flaw in the system. And then the system came down on him because it's not the retail guy that's supposed to make money.
Exactly.
And it will be interesting if this movie takes that through line, because probably before this, people just saw GameStop and they thought to themselves, I don't really. Okay, so there was this guy on Reddit. I don't really know if they were in the right or the wrong. This could have the potential to rewrite that history and solidify one particular point of view. And I think it's indicative in general of the mood in America right now. That it's indicative of what people want to see.
It's going to be such a great move for so many reasons. And Mesrick is just such a great writer. But the key on it is a Robin Hood story. And it is David and Goliath, but it is the Sheriff of Nottingham coming down, because it turns out if you piss off the wrong people, bad things can happen, because they have this, even after the losses, they still have more money than you. And my favorite scene, and again, I've only seen the trailer. My favorite scene is where I think it's the girlfriend of Roaring Kitty. How much we make today? He's like, 5 million. And
How
the
much we lose
wife
today?
of Plotkin, like, how much we lose today? $1 billion. And then the next day, how much we make today? 5 million. And she's like, wow, we're rich. And the wife's like, how much we lose today? $1 billion. And it's just, that's the world in which we live. And okay, Gabe didn't lose $1 billion. I mean, he probably lost hundreds of millions. I don't know exactly, but it was the client's money that went down $1 billion each day. Not, and maybe it was Gabe's. I don't know.
Post permissionless, because I know we got to run. I listened to a really good podcast interview with Lee Ainsley, who is the founder of Maverick Capital, I believe. Yep. And he was described, it's a great episode on just how to build a hedge fund, manage a business, how the industry has evolved over the years. You and I'm sure you have a lot of perspectives on hedge funds. I would love to get your take on that industry and how it's evolved over the years, because right. I listened to them getting a lot of flack because they underperformed the market, and market neutral hedge funds are not supposed to do that. I will do
it on one condition. You have to read the book by Kathy Burton, Hedge Hunters, of which the first chapter I did. And there is a chapter on Lee in there. There's a chapter on Julian. There's a chapter on all these great hedge fund investors. And Kathy is also a great writer. And but you have to read that book, and or at least the first chapter. You have to read my chapter. And
I've got a flight. I will listen. I have read More Money Than God, Sebastian Mallaby, which was a detailing of different hedge fund managers.
Yeah, this is a thin one, and this is a lighter version of those Money Masters ones that I can't remember the writer that did them, but where he profiles all these great investors, and Kathy did kind of the same thing.
Yeah, I think it's Jack Schwartz now. It's Market Wizards.
That's it.
Yeah.
Yep.
All right, Mark, this has been best hour of my week. I will see you in person very soon.